Welcome, everybody. I'm Ken Medlock, the Director of the Center for Energy Studies, and I'm glad to have many of you joining us today. We have a wonderful program to sort of kick off our weekly series again for 2021. Fantastic set of events that we held last year really sets the stage for a very robust set of discussions this year along many dimensions in the energy and policy space. I'm actually joined today by Jean-Baptiste Dubril and Gregory Monar from the IEA. Jean-Baptiste is a senior natural gas analyst and Gregory is an energy analyst. They're both going to speak today to the quarterly gas report that was released by IEA early this week. For those of you who follow natural gas markets closely, I'm sure you're all very, very aware of what has been going on in the LNG world, even in the wake of, and I say wake almost with a glimmer of hope, the COVID-19 pandemic. Certainly it has been incredibly disruptive for energy markets and economic systems around the world. And I'm sure that they'll both have something to say along those lines, but there's also been some really interesting occurrences in the natural gas space related to weather-driven demand and supply disruptions that I'm sure will enter the conversation as well. So if you have questions, before I hand it over to them, if you have questions, please submit them through the Q&A function. I will be fielding those in real time, and as soon as they're done going through their presentation, we'll pose those questions to each of them, and hopefully we can get into a lively discussion, and I look forward to hearing what they have to say. So with that, I'm going to pass it over to the two of you, Jean-Baptiste, Gregory. Welcome.
Well, thanks a lot, Ken, and good morning to everyone. It's a real pleasure to be with you, although virtually connecting from Paris to share with you the main insights from our latest quarterly gas market report. And as you've noted, Ken, this is a first for us because we used to publish this report on an annual basis, and now it's become a quarterly basis. As you pointed out, things are going very fast, and we are doing our best to keep up with things. And we thought that it would make sense to publish on a more regular basis, and here we are now. So I'd like to thank a lot the Baker Institute for having us today, giving us this opportunity to exchange on the findings of the report, and to have hopefully, I'm sure, a very lively Q&A session after this presentation. So without further ado, I'd like to start with giving you a bit of the contents of the report for those of you who have not had the opportunity to take a peek at it already. So first, to set a bit the scene, I don't know if you're able to see the presentation slides. Right, thanks a lot. So could you move to the next one, please? All right, thank you very much. So to set a bit the scene to begin with, so this may be something you're familiar with because we keep updating this record of the past 5 years to always keep things in perspective in the medium term. On the left-hand side, you have the evolution of global gas demand since year on year since 2016. What you can see is that we've had first 2 years of nice growth above 2% year on year globally, which was followed by what we called at the time the golden year gas 2018, almost 5% increase globally. After 2018, things started to cool down, with 2019 returning to the average below 2% that we had seen in the first half of the past decade. And of course, it did not prepare us for what we were about to witness in 2020, with the first an completely unexpected, very mild first quarter in the northern hemisphere, with a drop in heating demand throughout North America, Europe, Eurasia, and Northern Asia, and which was of course followed by the outbreak of the COVID-19 pandemic and some severe measures taken throughout Q2 to try to contain the pandemic, which also, of course, had an impact on economic activity and energy consumption. So our view, as of today, our estimate for 2020 is that global gas consumption declined by about 2.5%, which is to say about 100 billion cubic meters, roughly, to give you an order of magnitude, the annual consumption of Japan. This is, by all standards, for the gas market, an unprecedented drop. But at the same time, if you compare to other fuels, other sources of energy, and now I'm shifting to the other side of the slide, on the right-hand side, you see that gas has proven quite resilient in this very unprecedented context. You see that oil, according to our estimate, is in between -8% and -9%, and coal globally, they're about -5%. So gas did suffer, of course, like all sources of energy, but was proved to be a bit more resilient than others. And one interesting thing to mention is that if you consider liquefied natural gas as a standalone commodity, it actually grew last year. It grew by 2%, which of course is a far cry from the 10+% year-on-year increase that the industry was used to see, but still positive in this very uncertain environment. One of the reasons of this increase, and next please, is that gas benefited from low price environment that enable to trigger further fuel switching in power generation. Of course, the most visible example is in the United States, with the abundance of cheap natural gas, which helped pushing down coal generation, and in spite of an overall declining electricity consumption. According to our estimates, US gas for power generation consumption increased by about 3% last year, in spite of a decline of electricity demand by 2% in the US, and while coal slided by almost 20%. Outside of the US, the trend is a bit less visible. We see that in Europe, even if gas declined, it did not suffer as much as other sources of fuel for power generation. You can see there's also a major slide in coal and lignite used for power generation in Europe, especially over the second half of the year. And we also have some resistance and even some minor growth in emerging markets in Asia, with India and China both showing some increase in gas-fired generation against a decline in coal-fired generation, again driven by prices. Of course, this is a bit more anecdotic due to the fact that in both those markets, coal has an overly dominant position in the power mix, but yet gas was able to maintain its volume and even increase its volume in such a challenging environment. This being said, and in spite of those favorable factors, power generation was, according to our estimate, the most significantly affected sector in gas consumption last year, and it accounted for almost half of the demand loss that we have estimated for 2020, and dropped by about 40 billion cubic meters. So this is for the quick overview on the demand side adjustment on the to the crisis. I'd like now to hand over to Gege, who will guide you through the supply impact that we have witnessed last year.
Good morning, everyone. please allow me to join Jean-Baptiste in thanking the Baker Institute for organizing and hosting this webinar. It is a great pleasure to be here today and share this virtual roundtable with Kenneth Medlock and my colleague Jean-Baptiste Dupré. And now, if we move to the next slide, we will see how global gas trade evolved in 2020 along its main axis, namely global LNG, marked as light blue, European pipeline imports in dark blue, and China's pipeline imports in purple. The unprecedented 4% year-on-year drop in gas demand in the first half of the year was, of course, a real stress test for gas markets, unveiling the multitude flexibility mechanisms along the gas value chain, including production shut-ins, pipeline supply reductions, energy production curtailments, as well as optimizing storage utilization, both onshore and on the sea. And as we can see on this graph, pipeline supplies reacted first and bore the brunt of the supply side adjustment, facilitated by the short-term flexibility mechanisms embedded in pipeline contracts. We estimate that long-distance pipeline trade contracted by 15% or 40 BCM in the first 3 quarters of the year. And when it comes to LNG, despite shrinking gas demand, global LNG trade grew quite strongly, up by over 10% in the first quarter of the year. And in this context, Europe has been playing a crucial role by balancing out the global gas market. In the first 5 months of the year, Europe alone absorbed about 2/3 of incremental LNG supply, despite its plummeting gas demand. Higher LNG influx has been accommodated at the expense of lower domestic production and nominating down pipeline imports. The majority of LNG exporting countries also experienced varying degrees of supply curtailments through the summer of 2020. If we look at the third quarter, we see that global LNG exports decreased by about 7% year-on-year due to a combination of shut-ins induced by historically low market prices and both by planned and unplanned outages. And while the production shut-ins in the United States have been very widely discussed and mediatized, it is important to note that almost 70% of the production decline occurred outside the United States. As a result of colder winter temperatures and the recovery in gas demand, both in Europe and Asia, global gas trade returned to positive growth through the last quarter of the year, increasing by a mere 2%. This has been largely driven by higher pipeline imports into Europe and additional volumes of LNG flowing to Northeast Asia. Lower pipeline flows from Central Asia to China have been compensated by the ramp-up of Power of Siberia. And if we move to the next slide, we will see how closely prices have been following those changing market dynamics. The sharp drop in natural gas demand in the first half of the year led to a collapse in prices, which plummeted to decade lows across all major gas-consuming regions. As we can see on the left-hand chart, by late May, TTF in Europe, the blue line, fell below $1 per MMBTU, and Asian prices in purple color were trading below $2 per MMBTU through the summer, historical lows in both cases. And Henry Hub in the US averaged below $2 per MMBTU through the first half of the year, its lowest level since 1995. When looking at the second half of the year, the story is quite different, with all gas benchmarks recording strong gains supported by demand recovery, supply adjustments, and unplanned outages. In the fourth quarter, all benchmarks were trading above last year's price levels, and as we will discuss in a couple of minutes, Asian LNG spot prices ended the year with an unprecedented price rally. These strong price swings translated into a very high volatility, reflecting unprecedented market uncertainty that prevailed through the year. The months ahead volatility on both Henry Hub and TTF averaged at 65%, the second highest level for both since 2008. And when we are looking sort of a bit behind the lines, we can see that the inter-influence between regional hubs and markers continued to grow in 2020. So what does inter-influence means? It means that gas prices in a given market are becoming increasingly sensitive and responsive to the supply-demand fundamentals prevailing in regions beyond their immediate geographical reach. One way to measure it is correlation. And what we see is that the correlation between TTF and Asian LNG spot prices reached to 0.95 in 2020, its highest annual level on record. And worth to note that correlation has been particularly strong through the second half of the year, driven by improving market conditions both in Asia and Europe, and a more active competition for LNG cargoes. Most importantly, the correlation between Henry Hub and TTF and Henry Hub and Asian spot prices continued to increase and reached 0.8 and 0.75 respectively. So the rapid ramp up of US LNG exports, rising by more than threefold through the last 3 years, explain the growing inter-influence between Henry Hub and other regional price indices. In contrast, the correlation between oil and gas prices stayed relatively low and certainly well below the 0.7 annual averages experienced between 2012 and 2016, when oil prices had a greater influence on Asian and European spot prices. And if we move to the next slide, we will see the sort of practical implications of this low price environment on the largest Asian LNG buyers, who certainly benefited from the record low spot prices in the first half of the year and from lower oil index prices through the third quarter of 2020. Depending on the market, LNG import prices have fallen in a range between 20 and 30% year on year in 2020. And worth to note that buyers with a higher exposure to spot LNG, such as China or India, have benefited most from the declining prices. Having said that, the impact of the higher spot prices in December has been also more pronounced on those buyers. And we can sort of see that the LNG import price profile of both China and India displays in general a greater volatility because of the higher share of spot LNG volumes. Altogether, the LNG bill of the four largest Asian LNG buyers fell by over 20%, benefiting their economies and improving the cost competitiveness of natural gas, especially in the power sector, as mentioned by Jean-Baptiste. And now let's move to the more short-term market dynamics and the infamous Northeast Asian price rally through December and the first half of January. So if we go to the next slide, can we go back? Okay, no, please, can we go back to the previous slide? So before going into the the price rally, I think it is also important to highlight that one of the implications of that extremely low price environment was on the investments going into the energy sector. And if we go into the next slide, we are going to see how the investment evolved along the gas value chain. So can we, thank you very much. On the first graph, we see that spending on gas exploration declined in 2020 by over 40% to hit the lowest level in at least 2 decades. The drop in gas exploration is, of course, a structural trend which has been fueled by abundant unconventional resources, but it has been sort of accelerated by the uncertainties related to the global pandemic and its economic repercussions. On the second graph, we see that after a record year in 2019, when almost 100 BCM of liquefaction capacity has been sanctioned, over 40% of which in the United States, LNG FIDs has practically dried up in 2020, falling to its lowest level since 1998, and with only one LNG project, the Costa Azul in Mexico, reaching final investment decision. One of the key questions of 2021 is whether the LNG FID will restart, and if yes, at what scale. In contrast, orders for LNG carrier vessels held up relatively well. After a downturn in the first 3 quarters of the year, order activity rebounded sharply in Q4 as the LNG shipping market tightened and spot charter rates skyrocketed. Fleet operators ordered more than 50 new LNG carriers in 2020, about 40% more than the global 5-year average, but far below the levels seen in 2018 and 19. And when it comes to the development of LNG regasification capacity, it remained rather strong in 2020. At the end of the year, close to 200 BCM of regasification capacity was under construction, a 9% increase from the end of 2019. Nearly 2/3 of new regasification capacity under development is located in growth markets in Asia, where new infrastructure is required to accommodate increasing gas demand. And now, if we move to the next slide, it is just to discuss more short-term market dynamics and to refer to the infamous Northeast Asian price rally, which occurred through December and the first half of January. Northeast Asian LNG demand grew by 10% year-on-year between mid-December and early January. This has been driven by colder than average temperatures across the region, lower nuclear availability in Japan falling by close to 60% year-on-year, and lower coal-fired power generation in Korea, which has been limited due to environmental considerations. In China, gas demand was up by over 10 to 15% through the second half of December as a result of a cold spell, while pipeline imports from Central Asia have fallen below last year levels. Consequently, Chinese buyers had increased purchases on the LNG spot market. So how this additional LNG demand was met, and if we click next, we will see sort of the supply structure. And what we see is that the increase in Asian LNG demand sort of coincided with outages at the regional liquefaction plants, including Australia and Indonesia, leading buyers to call on more distant suppliers, in particular from the United States. And what we can see on that graph is that the US provided all the incremental LNG supply to Northeast Asia during that period. And this is important to highlight that up after providing downward flexibility through the summer, the US provided very important upward flexibility to the Northeast Asian market during the 2020-21 winter period. Of course, this led to longer shipping routes and eventually to the congestion of the Panama Canal. And if we move to the next slide, we will see that the growing mild tonnage demand, which went up by approximately 25% compared to September, and the dry up of the prompt vessels has been driving up LNG charter rates to record high levels, to above $200 per day from less than 30,000 6 months earlier. One vessel has been reported to be hired at over 350,000 per day. And this in turn provided further upward pressure to Asian LNG spot prices, which climbed to historical highs of above $30 per MMBTU by early January. And while this price rally has been rather short-lived, it reminds us that despite the growing flexibility of the global energy market, which of course helped relevant industries to find solution in this very tight market situation, the price fluctuations show that the market's short-term liquidity remains limited and timeliness remains an issue. And now I would like to give back the floor to Jean-Baptiste.
Thank you, Gege. So we'd like now to take you to 2021 and guide you through what we think will be the main headlines for this year's uneven and uncertain recovery to 2019 levels and pre-crisis levels, because we do assume that we will return globally at a global level to the pre-crisis demand levels by the end of this year. But there are some uncertainties, certainly. And first and foremost, it's not going to be a jump in terms of recovery. We do expect natural gas demand to increase by 2.8% this year, or about 110 billion cubic meters, which really mainly offsets the impact of last year, but not much than that. So it's not the same situation as what we have seen 10 years ago after the financial crisis, when in 2010 global gas demand increased by almost 8% year on year. So this is the first thing. It's got to be progressive recovery, and second, it's of course shrouded in uncertainty with two main caveats. The first one, if you look at the left-hand side, there's the breakdown of demand changes per region. And the takeaway is that all regions are not equal when it comes to recovery. Looking at what happened in between 2019 and 2020, you see that most of the decline comes from mature markets in North America, Europe, and Eurasia. Whereas what we do expect for this year is that it's going to be mainly emerging markets in Asia, to a lesser extent in the Middle East, that will drive this recovery. So by the end of this year, there is a likelihood that for some of the more mature markets around the Northern Hemisphere, gas demand will not have fully recovered to its pre-crisis levels. The reason behind that, and I'm moving now to the second aspect of this uncertainty, is that all the sector pillars of growth are all subject to major uncertainties, and you can see that on the second part of the slide on the right-hand side chart, where we've splitted the impact in terms of sectoral demand. One thing worth to notice, as I mentioned earlier, power generation that used to be the main engine for growth for natural gas globally is now in a difficult situation. It has been last year the main casualty of demand decline. And this year, we do expect that global electricity demand will be increasing very slowly, and that gas is likely to be squeezed in most cases in between growing renewables and a potential comeback of coal on more competitive prices against natural gas, which increases faster in terms of prices than coal does. So in terms of drivers, sectoral drivers, we do expect that for this year and the coming years, it will be the industrial sector that will be the main source of increase for global natural gas demand, especially in emerging market and particularly for Asia. Of course, the main question around that is the extent of recovery, both for those market and their export market, because the industry in emerging Asia is very much export driven. So any change in the pace to our recovery, economic recovery globally, will have an impact on this prospect for industrial consumption of natural gas. Last point I would like to emphasize is the role of residential and commercial, and particularly heating demand. We do expect some recovery this year, but this is mainly a one-off impact owing to the very mild winter we had experienced last year in 2020. So we do expect to see a normal winter more or less this year. So far, temperatures have proven us right, but you never know if we may encounter a mild end of season. After 2021, there's not that much prospect for additional growth in residential and commercial, the main exception being China, with continuous increase in both demand and also policies to switch coal to gas in residential and commercial boilers. And apart from China, we see also some potential for growth in Asia with the rollout of city gas networks in Asia, in India, Indonesia, and other countries. But of course, those countries are not are much less heating driven, so the consumption will be growing much more modestly than for temperature driven markets. So the recovery for this year is achievable, but it is certainly subject to a wide range of risks that hang on each and every region and each and every sector. So it's far from a given. One point also like to emphasize, next please, which is specific to the environment in which LNG market will operate, is beyond the uncertainty on demand. I was referring to the uncertainty particularly for the future growth of industrial demand in Asia, which is again the main driver for LNG markets consumption. Setting aside this uncertainty on demand, we also see that in the next 5 years, the structure of supply in the LNG markets is likely to be fundamentally reshaped. First factor you can see on the left, we expect that about 1/3 of volumes currently under contract will expire. So we're talking about almost 200 billion cubic meters of gas under contract due to expire in the next 5 years. You see that almost half of it is bound for the Asian Pacific market, plus a good share of what is under the multiple dark blue square is also bound for Asia. So it's again bound to the future of Asian gas demand. Second aspect, very important also, we don't know to which extent LNG demand is likely to rebound, but we have a pretty good view about how LNG supply will increase because of the impact of a huge wave of final investment decision that was taken in 2018, 2019. And as a result of this, we know that LNG liquefaction capacity will increase by 20% in the next 5 years. This is something that you can see in the middle chart. See that the flexible share of LNG in terms of destination flexible is increasing. This is owing mainly to the increase of US LNG in global LNG markets, so more flexibility. But another thing, which unfortunately doesn't appear on the legend there, if you look at the top green bars on the central chart, this is the amount of volumes which are currently uncontracted, which means that we of course do expect that some of those volumes by 2025 will turn into contracts, but as of today, those are still to find a home. So if we base ourselves on the view as we have it today, we see that uncontracted volume increase fourfold in the next 5 years. So this is an incredibly challenging environment for LNG sellers or LNG portfolio players to place new volumes in a very, very bias-driven environment. Last point wanted to highlight is on the evolution of pricing for volumes under contract, and this is on the third chart on the right hand side. You see that oil-linked LNG still bears a majority share. It is slightly declining, but especially with the expiry of legacy contract, but gas-linked volume still account for a minority of volumes, especially for final buyers, where there is still a tendency for certain traditional buyers to have a preference to use oil index contracts for longer periods of time because it's more liquid, because it's easier to hedge, and because for the time being there is still an absence of one market reference, especially for spot trading in Asia, besides the indices which are reported by agencies. So to wrap up on this presentation, next please. We'd like to share with you some takeaways from our studies and from the different topics that we've been discussing throughout this presentation. The first one is that gas has experienced last year an unprecedented shock. Like all the energy system, it had remained somehow more resilient than other sources, and it also gave a good example on how flexible the supply side could prove. And LNG, of course, did its share in providing this flexibility, downwards flexibility. We know that we used to see that LNG is flexible on the upward side where additional demand is needed, but when demands fall in a sudden and unexpected way, we also saw that in Q2, as Gege mentioned, LNG was able to bridge the gap and to adjust in a drastic way, minus 16% globally in between June and January last year. Second thing, the environment, the physical and pricing environment that we've experienced last year was marked by the huge changes in price levels and huge level of volatilities from historical lows that we're experienced in almost all markets throughout the world in May and June, up to the record-breaking levels of prices in Asia and very high prices in Europe that we've seen a couple of days ago. And this environment is, as we wrote a couple of days ago before publishing the report, and things tend to prove us right for the time being, it's not likely to last beyond the end of the cold snap. We do believe that a tight market is still far from us in terms of global LNG and global gas markets. We do see a progressive recovery, which will not be even for all buyers and for all markets. With more mature markets likely to see a more gradual recovery, some of them may not reach their 2019 level, pre-crisis level this year. Looking forward in the longer term future, LNG is again the key to the development of global gas markets. There's a sizable amount of uncertainty on the demand side with the path to recovery, especially in fast-growing markets in Asia, but also some structural changes on the supply side that create new opportunities for buyers and sizable challenges for marketers in this medium-term environment. Since the beginning of the crisis, the IEA has been standing with all the stakeholders along the LNG, the energy, value chain, the governments, the industry, and being able to assess the impact of the crisis, devise roadmaps, recovery plans, and as you may know, this year we're also embarking on delivering roadmaps for a net zero future by 2050 that the agency will publish by the end of this first half of 2021. As part of those efforts to increase transparency, awareness, and the analysis, this publication is now becoming a quarterly publication. It's again a great pleasure for us to have had this opportunity to present those findings today, this morning, with you at the Baker Institute. Thanks again for listening, and we're happy to take questions. Thank you.
Fantastic job, guys. And thanks again. And real quick for everybody who's listening, the link to the quarterly gas report is available on the event webpage. So if you just log into the Baker Institute, you'll be able to just click directly to it. It's definitely worth doing, worth a read, and good way to get yourself signed up to receive those reports on a regular basis as they come forth. And it's great that you guys are doing this more frequently because the market is undergoing an intense and very rapid change in many dimensions. And so I want to ask a couple of questions before I get to what some of our audiences has posed. And this is really just more in the data in terms of what you presented. So in terms of what you showed, it looked as if the majority of the reduction in gas demand overall globally occurred in Europe. Is that a fair statement to make, or was it much more broadly disseminated in terms of its impact across different countries?
Well, Europe was particularly hit in the first half of the year because it suffered from one of the worst impacts in terms of lockdown measures. We've had some countries such as France, Spain, or Italy, which had double-digit decline rates for H1 in terms of gas consumption. But some of those losses were recovered in the second half, thanks to fuel switching and also a bit of recovery with colder temperatures. So in the end, Europe is not as badly hit as we may have thought at a couple of months ago, and we're not thinking about -2, -3. Please correct me, Gege, on the figure, but I think it's in the ballpark of the global decline figure. And alongside the same numbers as for North America, regions such as Eurasia, which are heavily dependent on gas, not only for power generation but also for industry, in our view, have been badly hit. Also, of course, this is more of an estimate because it's more difficult to get actual figures for those countries, but we know that from the figures we get, at least from Russia, that the impact has been sizable.
Interesting. You also noted, so it will definitely be interesting to see how that that recovers as we move through 2021. And you noted the recovery is more progressive rather than a bounce, sort of like we saw after the global financial crisis a little over a decade ago. But one of the other things that you mentioned, and I think this speaks to what I'll ask you next about your view on short-term market balance. You mentioned on the supply side, we've seen some significant shifts in global trade via pipeline, via LNG, with LNG really faring better than pipeline trade, which is really not that surprising, as you noted, given flexibility in those contracted arrangements on the two different modes of transport. But the one thing that I wondered, I think a lot of our audience kind of shares this question, is on the supply side, particularly in the United States, we've seen this, but I know it's true in other places around the world. Associated gas production is incredibly important for market balance. And that, of course, speaks to what role the recovery will play in the oil sector and oil production in particular. And I wonder if you could take just a minute or two to talk about how you see associated production and how you've addressed it and what you've seen actually in the data over the last year and really how that might actually rebound as we go forward through 2021.
Well, this is a very important point, and thanks for highlighting this, Ken. The role of oil and therefore indirectly associated gas production is something that we're looking at, but the impact is very different from one region to another. As you said, it was instrumental in the U.S. We do believe that even if production U.S. production in the U.S. is on recovery, they still have an impact on associated gas, and we do believe that U.S. production for this year will still be slightly below what we've seen last year. For other regions, the situation is really different from one case to another. We've seen last year some extreme cases in the Middle East where gas was, we had some shortages of gas. I'm thinking of the Emirates, for instance, because of not enough oil being pumped out and therefore lack of associated gas. So some other places where dry gas is more dominant, thinking of Russia, for instance, the issue is a bit different. But it is true that for some heavily oil and gas producing areas, particularly in the Middle East and North African region, the impact could be sizable. There's also another impact is also on the use of when associated gas is not used as a standalone product, the use in terms of repressuring the reservoirs and the potential longer term issue for oil production in those countries.
Yeah, that's incredibly interesting, and it plays directly into the next question, which is really about long-term market balance and what that could unveil in terms of regional trade patterns. And there is a question that I will tie directly to this from one of our audience members. You noted Asia as being sort of the central to demand growth globally in the data you showed for the last at least 5 years, and certainly was true last year. And it has had a major role. It's all been weather driven, of course, but a major role in what we've seen at the beginning of this year. Going forward, though, can you comment a little bit about what you see with regard to recovery in gas demand and how much of that will actually be driven by Asian economies? I think this is a fascinating place to kind of dive into lots of different tangencies, because you also mentioned, not just its impacts on trade, but the implications of higher gas prices for coal gas switching, and sort of where you think you made the comment that you might actually see coal demand rebound a little bit this year and erode some of that potential for gas. So I wonder if you could expand a little bit on that and be a little bit more specific about which countries in Asia will drive demand and how you see that demand being sated.
Sure, certainly. Well, as you say, Ken, Asia is multiple and very very different markets. So I'll try to make it simple and just pinpoint a couple of example. So of course, and thinking about Asia, let's start with China, the most obvious one. Um, the demand there is mainly driven by industry and also by the government target in terms of fuel switching beyond the economic driven growth. But this year, we do not see that much of a strong increase in terms of Chinese LNG imports as we've seen in the past, because uh, there's on the one hand, the ramping up of domestic production and also the progressive utilization of that new Russian pipeline power Siberia to China. So, of course, China will still be a major player on the global energy market, but the increase is not going to be as astounding as we've seen in the past. And we do believe that Japan will hold the number one position in terms of LNG imported for a couple of years again. Um, India is, of course, another interesting example. Here, the situation and the drivers of growth are quite different. Um, the government has very strong and ambitious drive to develop a gas-based economy with a supply structure which is currently 50% domestic production, 50% LNG imports. The structure of Indian consumption is very specific because one of the main uses of gas is non-energy use. It's for feedstock for fertilizers and petrochemicals, which is a heavily subsidized and under scrutiny sector for the government. The competition in power generation is not that big for the time being because coal has a dominant position and renewables expand. But at the same time, we had seen last year some development in gas due to the very competitive LNG prices just before India went into lockdowns and Europe was not responding to the stimulus prices. But India is India is an interesting case because it is much more price sensitive than China and of course Japan and Korea, but it is certainly becoming a more mature gas market with more regular needs. At the other end of the spectrum, you have much more price sensitive buyers, thinking of Bangladesh or Pakistan, which really struggle to find the best fitting supply to balance not only their gas balance, but also balance their accounts, because again, it's heavily subsidized for the final buyer. Even if those two markets are heavily depending on natural gas. We have Pakistan, the share of gas is above 40% of the overall mix. And then the question of switching is also very important. It really depends on how well those markets can secure cheap LNG supply on the short term to be able to match their needs. So there's a lot of driver. In the longer term, what we're also looking at is what's going on in Southeast Asia, because we have seen several countries. I'm thinking of Thailand, Myanmar, or Vietnam, who have all made announcements last year to curb their coal consumption and increase LNG to power and renewables in the coming decade. So it will be also an interesting bunch of countries to look at, because all of them are facing depleting production. So they will become ramping up LNG importers in the coming years.
Yeah, this is fascinating for multiple reasons. I've had the pleasure of being able to do briefings for ministries in some of the countries that you've referenced, and a thing that is commonly raised is what the outlook for U.S. natural gas in the Pacific Basin is. Because one of the things that all of these countries are looking at is increased use of natural gas to facilitate transitions to cleaner energy sources as we move forward. And you referenced some of the work that's going on at IEA about net zero, 2050 net zero futures and pathways to get there. And I'm going to hazard a guess that gas plays an important role in a lot of those pathways, particularly as it juxtaposes against coal in some of these countries. But it raises an interesting question because there's a lot of people who are questioning the viability long-term of natural gas from the United States, particularly given the prevalence of flaring and methane emissions, notwithstanding the fact that those are oil production activities, but they're still, in the mind's eye when people talk about gas. So I wonder if you could maybe comment a little bit on maybe a little bit of a preview, if you will, on where you think some of those net zero pathways will go and what the likelihood, or what the importance, I should say, of U.S. gas supplies will be likely for some of those countries to achieve lower carbon futures.
Well, this is as you say, it's still work in progress, and we're very far from it. Even if we're on a tight schedule to make it, but a few thoughts on gas, and particularly on U.S. gas, as you mentioned. There's a lot of countries which are looking to transition away from the use of liquid fuels and coal, especially in power generation, to something cleaner. Of course, this something cleaner involves renewables, involves biomass, biogas, biomethane, but we do believe that electrification, a greater share of electricity in the energy mix, is a part of the solution. At the same time, we need to have alternative fuels, and 100% switch to electricity is a very daring prospect in the current situation, without the capacity to have large-scale storage, electricity and energy storage capability. So we need alternatives, and I think that gaseous fuels, including, of course, natural gas, will be part of this initiative. Within a transition in which natural gas, and at a later stage, hydrogen and biogas, biomethane could also contribute. This being said, and this is something that I also want to bounce back on what you mentioned, Ken. The gas industry needs to do some homework to make sure that it is part of that solution towards a cleaner energy. And we have released our annual methane tracker last week. And one positive thing, unfortunately, about the crisis last year, of course, the methane emission have declined, but that's not so much because the standards are improving that quickly. It's because the production of oil and gas being down, and we still see that there's a huge potential to improve the footprint of the industry, and in a lot of cases at negative cost, by monetizing the gas, making sure that it's properly used rather than being wasted. So I think that, yeah, gas is part of the transition, gases, including natural gas, but it has to also make its own transition, so to speak, to be part of that net zero future.
Excellent. I think that's a fantastic way to wrap today's webinar. I think a message that has some positivity for the gas industry, particularly if it becomes more inward looking. And I think that's something that you shared very eloquently there. So I want to thank you both, Gergely and Jean-Baptiste, for joining us today and discussing the quarterly gas report. I look forward to having you back. There's a lot of folks that are incredibly interested in this topic, and will remain so in our own backyard here in Houston, but of course globally. And look forward to seeing the more frequent releases of this information, because it's impactful and incredibly useful. So thank you both for joining us today, and to everybody on the line, stay safe, stay healthy, and look forward to seeing you next time.
Thanks a lot, Ken, for having us. It was a real pleasure and looking forward to the next time. Thanks again.
Thank you. Have a great day. Bye.